Okay, before we head in, just a note about the applied level. If you've gone to the applied level, you see the old pricing is still up. It was supposed to change on the 15th, but reality tapped me on the shoulder and said, hey, level 1 results are out on the 14th. Level 2 results are out on the 16th. Are you really going to change the price before they have a chance to grab the 320 price within the CFA plus? Because if we go to CFA, let's just have a look at where we are there. We'll select an exam. We'll just go with level 1 down here. Here is the the self-study plus applied level, right? It going from 399 to 719. There's 320 in there for the applied level. If I change the price, then that wouldn't have been included, and you had results. So I thought, well, then let's wait a week. That'll give everybody who is registering for all the level 1 who passed, who are moving on to level 2, all the level 2s that are moving to level 3. They'll have a week to get that in their price if that's what they want. Let's wait a week. So if you went to the site and you say, "Oh, he lied. It's the same price. He was just making it up," it's because I totally forgot that results were out last week, and I picked the 15th. So probably, I'm going to guess Tuesday or Wednesday of this week it'll change. I said wait a week. I'm not sure if it's going to wait a week from the Thursday or wait a week from the Wednesday. We'll see. But as of right now, it's still the original pricing. So everything still applies here. You have an X on new positions. Just ignore that. It just hasn't been updated. You will get new positions up to the date that this changes. Once the price changes, then we have the new pricing in place. We are entering the last 2 weeks of January, and volatility for the last 2 weeks. We've got so much coming up. Monday's a holiday, a U.S. holiday. All other markets are open. Predominantly the currency market. That's going to be a good one to watch. Inauguration Day and the inauguration speech, which I expect will be classic Trump fire and ice. I don't think the policies will be that, but he's not going to get up there and say, okay, tariffs, yeah, we're going to start small, we're going to be thoughtful about it, we're going to see what we can negotiate, if we can be friends. No, that's not going to happen. It's going to be fire and ice. The week after, we have the FOMC, and throughout, we have earnings. We have a calm week this week, I think about 40 reporting, but next week is big with earnings. And we have the FOMC, which everyone expects is going to be nothing. But does Trump start putting pressure on Powell to lower rates? We'll find out. Let's have a look at the week that we had. What a great week for both equity and bonds. If we look at the capital market curve, we basically, week over week, got about a half-point cut right across the whole curve. You can see the blue line here. Being this week, that is the opposite of a bear steepener. Bear steepener, bearish means up, right? Yields up, prices down. Bullish means that the yield curve is coming down. Yields down, prices up. Flattener means the distance between the 2 to the 10 is smaller. Steepener means the distance from the 2 to the 10 is higher. And there you go. You have a 3 basis point decrease on the 2 to the 10. That is a flattener. And you had rates coming down. That is bullish. That's a bull flattener on the yield curve. And that started Tuesday morning, PPI. As soon as I saw the numbers print, my reaction was, whoa. And I looked at the market and everything turned green right away. CPI reinforced it the next day. That was a nail biter. CPI reinforced it the next day, and then going into Friday, you have the rally into the long weekend in the expectation that Trump is going to say everything positive for the equity markets. We will see. This week is extra long because I do want to go into detail about the tariffs and about the inflationary impact of the tariffs. And we're going to look at the other side, which is regulation and the cost of regulation. And it may surprise you I looked at a number of studies, what the cost per household and cost per employee is on regulation in the U.S. I think that is a gold mine as far as a disinflationary potential. And then we'll spend some time at the very end looking at how we can think about the value of the equity market right now. Let's get back to our screen here. Jumping ahead a bit, January 29th, FOMC, we get that in 10 days. And the market, I think, has it right. Almost 100% probability that nothing will happen. And I think that's right. And I also think it's too soon for Trump to start pressuring the Fed. If the Fed stays on hold for too long, then that might be a problem. Given the read that we had, and we'll look a little deeper in inflation after this screen, given the read that we had, if this continues on, Governor Waller said that if that happens, you could have a rate cut, or that rate cuts could happen in the first half of the year, not the second half of the year. That would be 2 in the first half of the year, or 1 per quarter. My baseline is 3 or 4 for the year. Canadian CPI, we get in 2 days. Now, CPI, it measures what the consumer pays. So if you have an increase in the sales tax, CPI will pick that up, but PPI, final demand, will not pick that up. Canada introduced a GST holiday in December on a whole bunch of stuff, and this is going to measure CPI for December, so expect that to be low because of the lack of the GST on certain items. And PPI in 3 days, PPI will be at odds with CPI, because while the lower GST will push down CPI, it will have no effect on PPI. And Canada's retail sales for December in 4 days. Japan CPI in 4 days, plus the Bank of Japan is meeting. There is more thinking that they're going to make an interest rate move because they have been jawboning about the weakness of the yen. They are not happy with the weakness of the yen. That is an inflationary driver for Japan because they import most of their oil and energy of that sort. Any energy they don't produce with nuclear, they import because they have no domestic production. So the cheaper the yen, or the lower the value of the yen, the more expensive that is. I don't think that they're going to increase the cost of their debt, but they want to do something for the currency. They might go 10 basis points or something like that, something symbolic just to push back on the short sellers. Reverse repo down 118 billion. January 16th, it hit a new low of 94 billion. I expect that to be emptied very shortly. Reserves 3.3 trillion. That's 24 and a half months at 40 billion. TLT up 2%. SPX up 2.91%. Let's have a look at the futures term structure for the federal funds rate. Q1 pricing in 7.5, Q2 with 15. So you basically look like you have a rate cut there. Q3 at 9, Q4 at 6.5. That is a half cut somewhere in there. You've got 38 basis points in 1.5 or 1.5 cuts in 8 meetings. My baseline is 3 to 4, if not more, but I'm thinking minimum 3, maybe 4. Let's have a look at that CPI report we had. If you go to Google and you type in U.S. CPI report, you will get a link for the BLS, U.S. Bureau of Labor Statistics. Click on it, you'll land on this page, Consumer Price Index Summary. Scroll down and go all the way to the bottom, this menu bar here. Click on Data Tools, and you will get this screen up. Here's one screen. Here's all urban consumers. If you click on one screen, you'll get a pop-up, and I'll drag that onto the screen. And here is where we can find our multiple decimal places. So if we click on U.S. city average, all items, and you scroll down and you say add to selection and get data, a new window will open up. There you go. So the 317.685, this is 2024 for December. You can divide it by the year before, 30872, and you will get multiple decimal places. That is year over year. 317.685 divided by 316.441. This is month over month. You'll get multiple decimal places. And then you could take November divided by October. You'll get month over month. This is seasonally adjusted. This is not seasonally adjusted on this one. Be careful here because you have half one, half two. Don't just take this number up here. You gotta look at this one over here for December, 315.065. If you take the adjusted and unadjusted year over year, you should get the same thing because year over year, it includes all of the seasons. The other thing I want to show you with the pop-up, let me move this over here. If you scroll down all the way to the bottom, in the second window, where it says select one or more items. And if you scroll up, you get a whole bunch of the sub-indices here. So here's all items less food and shelter, all items less food, shelter, and energy. Right there is your super core. So you have a whole bunch of the sub-indices that you can click on down here if you want to get a little bit more detail. Okay, with that said, let's see what we have. CPI, year over year, 3.248%, month over month, 0.225, which is 2.73% annualized. October was 0.28, month over month. November, 0.308. December, big drop down to 0.225, even lower than October. The super core, 2.125%. Look at that. You're pretty much at your target. Month over month, 0.1975. Back to where October was at 0.194. That is 2.396% annualized. Rent, still a bit of a problem. Year over year, 4.6%. That's not really true. Month over month, 2.538. That's not really true because rent concessions don't change the rent price. So CPI is looking at prices. It's not going to capture the rent concession. So let's say you're looking at a place that is $2,000 a month, which is $24,000 a year. It is becoming more and more common to get 1 month or 2 months free. You get 2 months free, you're down to $20,000 a year. That's a 15% lower, well, 16% lower price. However, the price will still be $2,000. And how the REIT or any, typically with REITs, how they would do it if it is an apartment REIT, is they still record revenue of $24,000. And then under their costs, they'll have concessions of $4,000, so to get to a net operating income, well, closer to the net operating income of $20,000. But the headline price is still going to be $2,000, showing that there isn't much of a decrease in rent, but there is a really big decrease in rent. If you go to Redfin and you look at their rental index versus where CPI happens to be, you'll see how much lower it actually is. And I think that's probably because they're considering the concessions that are in there. So CPI is not picking up these concessions, and concessions have been increasing. Higher rates leading through to mortgages isn't going to change this. It's not going to fix this, nor is it going to fix car insurance because it is a legal requirement. You have to have it. You have no choice. You have to have it. So it's not as if higher interest rates will reduce demand. It's not as if I say, oh, I'll just cancel my auto insurance. I have no choice. Either I park my vehicle and I don't drive it, or I continue to pay it, which, it's going to take significantly higher rates for me to say, okay, well, let's just park the thing and not use it. So you have no choice on this. Lower rates isn't going to increase demand here. It is its own thing. Year over year, 11.3%. Month over month, 0.404, which is 5% annualized. And in case you want to dismiss this, it has a 3% weight in the CPI. So it does add a significant amount, especially that year over year at 11.3%. Oof, insurance. Now all of this is December. What else was going on in December? Well, if we look at December and we say, oh, but employment sucked, retail sales were negative, and the economic activity was really low, we could say, well, okay, that makes a lot of sense that inflation should be lower. But December jobs came in at 256,000. Manufacturing PMIs increased to 49.3. That's up 0.9 in December. Retail sales up 0.4 off of the back of November being up 0.8. This is month over month. So November was up 0.8. December was up 0.4 over that number. If we look at the control group, it was up 0.7. The control group just takes out volatile items. So things like energy or food that have decreased in price, that's where you're getting your 0.4. If you take that out, you're actually 0.7, and this is a better measure of consumer spending, and more. It is closer to what will go into GDP. Up 0.7. PPI final demand 0.2. If you look at the core, 0. Just to remind you what PPI final demand is, you have a consumer and you have the producer that's selling something to consumer. CPI captures what the consumer pays. PPI captures what the producer receives in the same transaction. They're just on opposite ends of the transaction. That's PPI final demand. The core, 0%. CPI, rather benign. PPI, rather benign, but very strong economic activity. Good job creation, strong retail sales, manufacturing coming back, sitting just below the contraction point, month over month, just below. But what do we got coming up? We got tariffs, which could be inflationary on price. You got deportation, which could be inflationary on wages. But on the other side, you have deregulation. How much does that stuff cost? Let's just take a little while and see if we can dig into some of this stuff. Okay, let's look at regulation and regulatory cost or regulatory burden. And let's look at deportations. And then we'll go visit ICE because we can get accurate numbers from ICE. Their database is public and we can see where they're making arrests, the type of arrests, what cities they're making arrests in, how many are put in detention, how many are exported, how many are deported, exported. Let's start with regulation. And I'm concerned when I look at this about the source that I'm getting this from. This is from the House Committee on the Budget, which cites the Competitive Enterprise Institute not being politically leaning on the U.S. I don't know if this is left-wing or right-wing. So I looked around to find costs from a bunch of different sources. I found some from Cato Institute and the National Association of Manufacturers. What I did find is, regardless of what source I found, it was all pretty much in the same neighborhood. So we're just going to take this. A recent study by the Competitive Enterprise Institute, this is August 7th, 2024, quantifies the annual cost of this is just federal regulation. CEI scholars calculated the federal regulatory burden cost the average household more than $15,000 per year and costs $2.1 trillion in additional annual costs to Americans. To put that in perspective, the household income tax burden is $2.3 trillion. So it's almost as much with regulatory compliance and the costs of regulations being in place, almost as much as the income tax burden. Business, this is from Cato Institute, regulatory compliance is estimated to be about 3% of total wages in the U.S., about 3%. So if you can cut out regulation, even if you have deportations which lead to wage inflation, if you can offset that with a decrease in regulation, it might be a neutral. Not only that, you could have an economic stimulus package here if you can cut out some of that 2.1 trillion in regulation or the burden of that. National Association of Manufacturers puts it down as the cost per employee for all federal regulations is about $12,800. This is from 2022. They estimate the cost for regulatory compliance per employee, $12,800. Economic, regulations, $7,700. Environmental, $2,800. Tax, $13,000. I don't know that you can do much with tax compliance because you do have to withhold taxes, and you do have to remit taxes. And yes, somebody in the accounting department has to do that. You have to collect any VAT or sales taxes, and you have to remit those taxes. And yes, somebody in the accounting department has to do that. I don't know that you're going to get rid of that. I don't see much there. The environmental, I would be cautious about how much you want to remove. I mean, we do want clean air, clean water, and uncontaminated soil. I think we do want that. The economic, 7,700, I think there you probably have some room to cut. Let's go on to deportation here. This is January 16th to January 20th. This is the source of this is ICE. Here is Trump in the level of deportations, and here is Biden during his 4 years, significantly ramped up. For 2024, 526,000 through August. That's about 66,000 a month. Trump never got to the level that Biden got to. That's about 2,200 a day. All of the undocumented people in the U.S., the estimate from ICE is that about 75% of them are working, 25% are not. But when you deport, you're deporting 100% of their demand. So if you grab 100 people at random and deport them, you're deporting 75 workers, but you're deporting 100%, 100 people who have demand in the U.S., who eat, who live, who buy clothes, who drink beer, who go to movies, who spend money. About 70 of the workers, about 70% have high school or less than high school, 13% with a BA, 18% with a BA plus. So you could argue that, well, when we deport someone, it's going to cause wage inflation because you have to replace them with a domestic worker, and maybe there aren't enough domestic workers. You're reducing the size of the labor force. But you're also reducing aggregate demand at the same time. You grab 50,000 people, you send them out of the country. Out of those 50,000, you've lost 37,500 workers, but you've lost 50,000 consumers, right? So you can argue that it could be wage inflationary. However, the drop in demand would require some businesses to say, well, we really don't need that many people. We may not need to replace the cook who got deported. Because with all the people who are getting deported, the traffic volume in our restaurant is actually lower. So you may not need to, right? And keep in mind, you're already running at a rate much higher than what Trump was running at. So when you think, well, losing 37,500 workers, this year, the pace of deportations this year has been 66,000 a month already. So if this is what Trump did and this is what Biden has been doing, how much more can you grab per day? You're already grabbing sending 2,200 a day. So you'd have to use that as your baseline. So when we start hearing numbers that they're deporting, 60,000 a month, you say, well, Biden was higher already. That's actually fewer deportations. That actually would be deflationary, wouldn't it? So you'd have to see a number of deportations exceeding 66,000 a month. And we can get live, well, as close to live as you can, by watching ICE. So let's find out. When his fire and ice speech is going to be tomorrow, we're going to get him out of the country, we're going to get him out of the country, rather than saying, oh my God, this is going to be massively inflationary. Keep in mind that you're deporting 100% of the demand, but only 75% of the employment based on these numbers. And we can watch ICE's site. And if Trump can come out and claim we are deporting more than when I was president, that number is up 20%, from 50,000 a month to 60,000 a month. You can tap on the shoulder and say, yeah, but Biden was doing 66. You're actually leaving 6,000 more in the country. That's actually deflationary, right? So we can see it, but let's go have a look at ICE. Okay, here is the site for ICE enforcement and removal. And we can just scroll down. We get a number of different charts up, and all the data in here. It's hard to get, minute by minute data. This data is as of the end of the third quarter. I think it's updated quarterly, so we should get the December update at some point. Arrests 500,000, and it breaks it down arrests by criminality. And if you scroll down, it gives you the cities. Arrests over time, areas of responsibility. That should be no surprise because your southern border is right here. And arrests by country of citizenship. Does this surprise you at all? The darker it is, the person who was arrested comes from that country. Well, what's the biggest problem for the U.S.? It's the southern border. Canada arrests 562, whereas if we just look at Mexico, 143,000. 562, 143,000. If you were going to punish a country because they weren't defending the border for you, which one do you think that you would focus your attention on? This really short border where 144,000 people were arrested. This is just the ones that were arrested, 144,000 versus 562, right? Let's go down to detention, the ones who are thrown in jail. 545 out of Canada, out of Mexico. What do you got? 191,000. 191,000. And deportations. This is, there's 500, there's where we get the number for, as of September 30th, 545, 252. Look at the progression. 2021, 2022, 2023, 2024. Removals for criminal conviction, 68,000. So when Trump is saying the criminals, we got to get the criminals out of the country, Biden has in the first 9 months of 2024, 68,000 people removed just on criminal conviction. You have another 20,500 for a pending criminal charge, and you have 187,000 for other violators. And again here, 591 versus 207,000 of the ones that were deported. 207,000 were from Mexico. 591 were from Canada. Do you really want to slap Canada with 25% tariffs and Mexico with 25% tariffs when the difference between those two numbers is night and day? That's why I don't think that he's that serious about Canada. And when we look at the trade balance, I think you'll see that it's going to be difficult to think that you're going to get 25% tariffs across the board. Mexico, I think, will probably have more trouble than Canada, because Mexico has also shown itself willing to be a backdoor for Chinese imports. So that might be a bit of a problem. Anyways, here's the site that you can watch. It's as close to real time as you're going to get. It is, as of the end of September, but if you look around at other websites for some of their data, you're getting stuff from 23, stuff from 2022. At least this is as current. If anyone knows of anything more current, you go ahead and put it in the comment box. So again, with roughly about 66,000 a month, it's important to watch what comes out of the White House for February, March, April, because they will publish those numbers. We deported this many, because they want to say that they're making this progress. That's the hurdle rate, right? That's the hurdle rate. It has to be more than 66,000 before you start saying, okay, that's going to affect wage inflation. Because if you're already averaging 66,000 per month this year, you can't say continuing on with 66,000 per month will add to wage inflation, because that's the baseline already. If it's less than 66, it would be disinflationary. So let's see if he can beat Biden's hurdle rate. Let's move to tariffs. I put down two statements in white that I believe are true. Number one, they are going to happen in some form. And number two, there will be retaliation. I've got a continuum here from across the board tariffs to very targeted. And he has mentioned Canada and Mexico. At one point it was 10%. The last number's 25%. I don't know where he is in his head now. China, 60%. Some things 100%. Chinese automobiles, 100%. And I have very targeted. Again, they're going to happen. There are going to be tariffs. Maybe they're very targeted. So Canada and Mexico might be exempt on energy and food. Autos and minerals, there might be a carve out for autos. And China might be exempt specifically for rare earths, because there are some inputs that China pretty much controls, and there are some inputs that the U.S. has no production of at all, like antimony. There's germanium, gallium, chromium, tungstates, graphite. China has a huge amount of these. I think in graphite, something like 90% of the world's refined graphite comes from China, and the U.S. imports more than 50% of their imports come from China for these materials. You could really cause problems in the U.S. if China decides, you know what, you're not going to have any of this stuff. Well, we're not going to hit you with tariffs. You just can't have any of this stuff. We can't have NVIDIA chips, and you want to hit us with 60%. You can't have this stuff. That would be a problem. This is used in defense technology. They could be withheld to negotiate other exemptions or lower tariffs. I think somebody in the inner circle there is going to say, Mr. President, dude, we need this particular thing, and there's really nowhere else that we can get it. And the Chinese ambassador just said, fuck you. If we put tariffs that we're not going to get, it's going to be a bit of a problem. I think it'll be something else. I expect Canada will end up somewhere here in terms of target. Mexico will end up somewhere here. China, I think they'll be able to get something out, but I don't know that they'll escape the worst of it. There will be retaliation. Canada's already sort of announced what it will do. If the U.S. announces tariffs within 2 weeks, they will hit back with tariffs on $37 billion of imported goods from the U.S. If the tariffs on Canada are near this extreme as opposed to this extreme, they'll follow it up with another $110 billion if needed. And if it is across the board tariffs, you can expect retaliation from every country. And if they're more targeted, the retaliations will also be more targeted. The net result is you're going to have a decrease in international trade with all of these tariffs and counter tariffs, which will lower real GDP growth in every country. There is I think, changing or shifting narrative in the U.S. lately that, you know what, all the thinking and all the history with all the observations and all the economists saying that tariffs are negative, maybe that's not true for us. Maybe we're so exceptional it's not true for us. Maybe with all the tariffs we can actually accelerate growth. Nah, I think that's just a story being told to make it more palatable. But tariffs will lead to higher import prices. Across the board tariffs will cause other currencies to depreciate, nullifying the effect of the tariff and the gains that the U.S. thinks it's going to get from increased employment. Probably not going to show up. This is going to be a big thing to watch tomorrow in his speech. What does he say about tariffs? I'm sure he's going to say something about it. He'll say something that the U.S. is being treated unfairly. That ends today. From here on in, America first. These people will pay for ripping off the U.S. for all of these years. I'm on day one. I'm heading over to the White House now to sign executive orders. To start the implementation of tariffs. I don't think he's going to be specific, but he's not going to be calm. He's not going to say, well, we're going to think it through. We're going to meet with them. We're going to see what can get done. It'll be thoughtful. No, not in a speech. So watch the CAD. Watch the peso. CAD sitting at about 1.4 close to 145. It starts making a run to 146, 147. I will buy the Canadian. Peso is below 21, 20.8. I'd have to see 21.5. Pushing to 22 before I start nibbling at the peso, because I think Mexico would be be punished more than what Canada would be punished at this point. So I think that if he's unspecific and just fire and ice, expect the Canadian and peso to really take a dump. I would be picking up the Canadian on any big move. 146, 147 I would start. For me, it makes sense because I got a lot of US dollars, but I do have a house in Canada which has Canadian expenses. So to be able to send some of those US dollars back to Canada at that 146, 147, 148, yeah, bingo. I'll take it. But I don't really need pesos. So that one would purely be speculative for me because I don't need pesos. So it's not like heads I win, tails I win. With the Canadian, I win both ways, but I don't really need pesos, so I'd be a little bit more cautious on that. So just to give you some idea of why I would probably pick up the Canadian dollar on any weakness. The U.S. market is closed tomorrow, but currency markets are going to be open. Globex will be open. And I don't know if any of the ETFs will trade. They pretty much trade almost 24 hours a day now. You can buy quite a few stocks 24 hours a day. I don't know if they'll be available for trading because that makes them available outside of U.S. market hours. So I wonder, is it a holiday? Will they just be shut down entirely? I don't know. We'll find out. Here is a map of trade with Canada and the U.S. in terms of energy. It's hard to read because there's so much in here. This is as of 2020. The link for this chart and the site is in the description box below. But the trade has only gotten bigger. The current numbers are, if you take the last year of trade with the U.S. and you take energy out, just take energy out, U.S. actually has a trade surplus with Canada by about $58 billion a year. So they send, without energy, Canada has the trade deficit. Canada should be hitting the U.S. with Trump-style tariffs and call them Trump-style tariffs so that he can respect them, because that's what he's doing. Energy is critical in the type of energy that heads across. Let me see if I can find the graphic here. Okay, and I'll try to read off some of the numbers to you. Up here where we have 85, that's 85 billion a year in bilateral energy trade, 77 terawatt hours of electricity trade across 35 major electricity transmission points. If you hit that across the board with tariffs, you are going to raise electricity prices, and you can see where the states are. The darker the states, the more they rely on Canadian energy. This over here is 70 petroleum and natural gas pipelines, cross-border petroleum and nat gas pipelines. The 5.06 million is barrels of crude oil and petroleum products traded daily. There are refineries in the U.S. that are built and set up to refine a specific type of crude. If you don't get Canadian crude, that's it. Everybody go home, shut down. It would be a costly retrofit to refit it for West Texas, even all the way down to the Gulf of Mexico. A lot of those refineries are set up to process Mayan heavy. 9.32 billion cubic feet of natural gas traded daily. And this over here, $74.8 billion, $75 billion in minerals trade. This was the whole concept of the free trade agreement when it was first conceived of is that Canada is rich in natural resources. Mexico's a great source of cheap labor, and the US is a great source of capital. So if you combine the three into one big trading block, every country benefits. Well, that looks like it's going to be reversed, which is odd because Trump, under the last Trump regime, he shit all over the North America Free Trade Agreement, renegotiated, and now he's shitting all over what he renegotiated. That guy. But this is why I think it's going to be difficult to do the 25%, because once you get rid of energy, you actually have a trade surplus. It's going to hurt the U.S. a lot more. Well, I shouldn't say a lot more, but it's going to hurt the U.S. a lot. It's going to really hurt Canada, but really hurt the U.S. a lot, especially these northern states, especially in winter, right? So here I've got sort of some macro trades that I would be looking at depending on the type of tariffs that he's putting on. If it's going to be across the board tariffs, 25% on Canada and Mexico, 60 to 100% on China, 10% on everyone else. You got to be short U.S. beta at that point, because there will be retaliation and everyone will hurt. And the U.S. equity markets are already richly valued for perfection. This is something they can't handle. I think you got to be short U.S. beta. Definitely short ocean shipping for two reasons. A record number of ships are coming online this year. A record number of tonnage is hitting the water. And if you have less international trade, well, there's less to carry around. Double on gold. I would be very bullish on gold because across the board tariffs, the inflation story would show up and gold really does well. You'd probably have a strong US dollar as well in the short term, and then I think you'd have a weaker US dollar mid-term to long term. I do think the US dollar is not going to continue its strength, but it is where it is right now, and I think it'll be here for a bit, not a minute, but a bit, and then I think it starts to head down. I'd be neutral to negative Bitcoin in the short term. Bitcoin has not shown itself to be a very good inflation hedge. When inflation does show up and the market is risk off, so is Bitcoin. Bitcoin is not a real inflation trade. It's more of a risk on, risk off trade. I'd be cautious on duration short term. I think you'd see yields rise. Maybe you get a 5% 10-year. And if you did, then for the midterm, long term, I would be positive duration, because at a 10%, a 5% 10-year on a market top, if not a market top, but on a yield top, you'd have a market bottom. I still think it would be difficult for the U.S. equity markets to outperform duration this year under a condition like that. Keep in mind, in 2023, when yields topped out, equity markets bottomed out. We talk about the October highs for the yield curve for 2023. The opposite side of that was also the October lows in the equity market. Equity markets can handle the yield curve bouncing around, the 10-year bouncing around from 3.7 to 4.4 without much of a problem. Once you get to 4.4, 4.5, 4.6, 4.7, 4.8, nope. The equity market cannot climb that. Look at the last couple of weeks. Take out the inflation data from last week, but the 2 weeks before that with the bear steepener. And everyone talking about, oh, we're going with 5%, 5.5% rate. Those low rates are gone. Up and up we go. Markets were just going straight down. They'd try to rally, and then they'd lose the rally all day long, and red. That's what we had in October of 2023 when the yield curve kept steepening. In a bear steepener, the yields kept going higher and higher and higher. Equity markets kept going lower and lower and lower. You'd get the same thing. So if you're going to get higher yields in the short term, you're going to get lower markets. And plus U.S. energy, because if it's across the board, you're going to shut down a lot of energy imports. going into the U.S. You're going to boost energy prices in the U.S. You're going to really lift those energy prices, especially nat gas. So I'd be thinking that would be the trade there. If they're more targeted, that doesn't make me bullish U.S. beta. I'd be neutral to slightly positive U.S. beta. The question would be, could the U.S. equity markets outperform the bond market this year? I'd be negative to neutral ocean shipping. I still wouldn't be a buyer here. I'd be plus gold still, and then I'd be adding copper plus copper, because I'd be thinking you're going to get a weaker U.S. dollar, which will really help the price of copper. What has been impressive is with this strong dollar, copper is still in the $4 range. It has not broken down under 4. It threatened a couple of times and just held the $4 range. At this level of the U.S. dollar, for copper which is priced in U.S. dollars, to still be in the $4 range is super impressive. I would be long copper here. Short the U.S. And when I say short the U.S., I particularly mean long the Canadian and long the peso against the U.S. You got to be long Bitcoin and definitely long duration. The reason I have this really bullish on gold, but neutral to negative on Bitcoin, why they are so opposite, is because gold has both reality and belief. Bitcoin only exists in belief. So before you hit the comment section saying Bitcoin is real, understand what I mean by reality. Reality is that which still exists even if everybody stops believing it. So if everyone lost their belief in gold, gold would still exist. There'd still be gold. There's a gold bar. There'd be gold jewelry. It would still exist whether you believe it or not. Just like gravity. Whether you believe or don't believe in gravity, it still exists. I wouldn't suggest jumping off a building if a TikTok trend out there said there is no gravity. You know how everybody on TikTok likes to, do the copy videos and say, oh, look, I'm doing it too. I wouldn't advise it. But Bitcoin, if the belief goes away, it goes away. There is no reality beyond the belief. The belief is strong. Now, belief is nothing you could just scoff at. Religion has existed for how many millennia on pure belief? There is no reality there. It's just a belief, but it has power in the world. Belief, however, is easily shaken. So if you do have a risk-off environment, that belief turns risk-off as well, because it's not backed by any reality, which is why I have these opposing trades in an across-the-board scenario where if you are thinking bearish on equities, you are pretty much bearish on Bitcoin, probably at a higher level because it is so much more volatile. It has Bitcoin here. I'd say if I did a regression on a commodity index and an equity index, it would load heavily on a equity index. But if I did that to gold, if I regressed it on a let's say an equity index, not a commodity index, but let's say I used I could use a bond index, for example. I'd bet you this would load probably heavier on duration than on beta. And then if I used, let's say trying to think, maybe M2. If I regressed it on an M2 index, it would probably load better on this than Bitcoin would. I think that any coefficient on the M2 from Bitcoin would disappear as soon as you add the equity market in. But for M2 in a regression, if you had, let's say you had the equity market, you had a bond index, and you had M2, it wouldn't surprise me that you'd have an insignificant coefficient on equity, you'd have a significant coefficient on bonds, and a really significant coefficient on M2. But with Bitcoin, if you regressed it on equity, on bonds, and on M2, I don't think you'd get any loading on here that's significant. Your biggest significant one would be here. Let's have a look at where we are on S&P. It was a good week. All-time high still sitting at 607.39. Now only 1.63% below. Last week we were 4.5%, 1.6. The small caps, IWM, almost 4%. IJR, a little over 4%. They've exited correction territory. They were down both over 10% off their most recent highs. IWM's now a little under 7% below its most recent high. Same with IJR. Our forward four-quarter operating earnings sitting at 273.18. Closing index pretty much at 6,000 there, 59.96.66. Gives us an almost 22 times forward earnings versus 21.35 the week before, and lower volatility on the S&P 13th week percentile, 45th percentile, down from the 81st percentile, and TLT as well, the 45th percentile, down from 55. Looking at implied volatility, the last reading on SPY, 12.7, down from 15.7. Big drop in volatility there. For TLT, 14.4, down from 14.9. A drop, but not that much. The open interest put-call ratio, 2.33, down from 2.63. And for TLT, 0.47, down from 0.63. I wonder if that is telling us now that we are past plumbing the depths of TLT. But we do have that speech tomorrow, and if it's fire and ice on tariffs across the board and every country is going to pay, yeah, I think bond yields will take a dump. Well, when I say take a dump, I mean bond yields will rise and bond prices will drop. We have earnings this week, but it's a light week, only 37 companies, or 40, depending on who you want to pay attention to on something that should be so easy to verify. Huge, huge problems. Imagine, the more difficult things, and you pay the money. I'm tired of complaining about them. We'll go have a look at who's paying, who's reporting. Next week is the big week for earnings. This week is big for fiscal policy and some earnings. Next week is big on monetary policy and big on earnings. What else can you hope for or ask for a big blowout at the end of January? Let's go have a look at what they're doing. And then we're going to look at some price targets for year end. And we're going to look at some competition the equity market has. And we're going to ask some simple questions is, can the equity market outperform cash this year? And you may say, oh, yeah, easy. Well, let's have a look. Let's go to earnings first. Okay, closed on Monday. Tuesday, January 24th, you got 10. Netflix, the big one here. You have Charles Schwab. You have a couple more banks coming in. United Airlines, who else have we got? Seagate, Prologis. Prologis is an industrial REIT, data center, not data center, sorry, logistics centers, I think the largest in the U.S. And then D.R. Horton, home builder. Let's look at the 16th. Halliburton and Kinder Morgan in the energy sector. You have some more financials in here. For technology, you have a few. Procter & Gamble in staples, and Johnson & Johnson and Abbott Labs in the healthcare space. Freeport, if you're a holder of Freeport, they're on Thursday. Union Pacific, CSX, a couple railroads. Texas Instruments in here, and on Friday, Verizon, which means AT&T and T-Mobile will probably be Monday and Tuesday. American Express, NextEra, big Florida utility company, a mostly regulated utility, has been under pressure for a while. It was well in the 80s, and then it retreated. It printed in the 60s for a while. It's back in the 70s, 71 and change. under 72. So they report on Friday. Okay, let's go through a little exercise in thinking about where the equity market has probabilities of ending up. Rather than coming up with a price target for the market, let's come up with a price target it must beat. How does that sound? And then we'll ask ourselves, does it logical for it to beat that price target based on its competition? Let's start with cash. Right now, the 3-month T-bill is yielding 4.43. The FOMC sees 2 cuts over the course of the year. The market only sees 38 basis points of cuts. I will take the 2 cuts from the Fed, which is more aggressive than what the market says. So for the average for 2025, if you cut twice, your average on your 3-month T-bill will be 4.18. Can the equity market deliver 4.18% return this year? It has about a 1.4% dividend yield, which means we'll calculate what's called a cash indifference price for the market. That means if the market here with 2 cuts, if the market finishes at 61.6680, that is 2.78% higher, plus the 1.4 dividend would give you the same return as cash. Can the market finish the year at just a little under 6,200 from 6,000 now? And if it does finish at 61.66, you took on a lot of risk to get a cash return. If you only get 1 rate cut, that would make the average of cash higher during the year. The cash indifference on the market goes from 61.66 to 61.74. And if you get no cuts, if you're in the camp of saying, oh, they're not going to cut, the S&P would have to get to 61.81 just for you to be indifferent with cash. Now, you're going to take on more risk by taking on the equity market over cash, because cash you are definitely, absolutely, 100% going to get 4.18% return. Absolutely guaranteed with 2 rate cuts. You're going to get 4.43% return if you have no rate cuts. Absolute. With the equity market, it could go down. It could be down 20%, could be down 5%, could be up 20%, but it could be down. That's the point. So when we say, can it beat 61.80, keep in mind you're talking about a distribution. There's 6,000. If we think about a normal distribution, 50% probability that your returns will be negative. There's 50% that it will be above. So right away at 61.66, you can't say, oh, there's an 80% chance. It's something less than a 50% chance given the distribution, but I'll be a little bit more generous than that. You want to get paid for risk. Otherwise, if we think that the market's only going to end at 61.66, I'll take cash, thank you, because I have no risk with cash. So I'm going to want something, some kind of premium for the risk. That's called an equity risk premium. Let's say it's 450 basis points. So instead of 2.78, I got to get to 7.18% capital gain on top of my 1.4% dividend, which means I need a price target with 2 rate cuts of 64.36. And if it gets to 64.36, then I have been compensated for the risk that I've taken on. That's all. I haven't got any excess return. I've gotten the return. I've gotten the appropriate risk return. Because obviously, if I'm only going to get 61.66, why not just stay in cash? Why would I take on that risk if I can't get more? This is just properly compensating me for the risk. If we get no cuts, 64.51. But if you get no cuts, your probability of the market going up drops significantly. So have a look down here. 2 cuts. Here's the 6,000. And I put some probabilities in here that I'd say coming off 2 very strong years, if we take a 10-year that remains unchanged and it stays at these high levels, there's probably a 30% probability that this year finishes below 6,000. I don't know where, but below 6,000. 70% that it finishes above. I say there's a 10% chance that you're somewhere between 6,000 and 6175, a 20% chance that you're between 6175 and 6445, and a 40% probability that you can beat the 6445. So if I said, let's just take the cash rate. If I said, you can have cash or you can have the equity market, there is a 40% chance, if you take the equity market, that you would have done better in cash. You might say, well, 60% chance that I'll do better, 40% chance that I'll do worse. Okay, maybe. If I said, well, there is a 60% chance that you will just earn the risk premium, but you won't do any better than that. Well, you might still say, well, with 2 cuts, I favor equities over cash. Okay. Let's go to 1 cut and 0 cuts. At 1 cut, I increase the probability. If there's only going to be 1 cut, I increase the probability that you'll have a negative year. Again, the higher that curve goes, the lower the valuations become. I put 33, not much, 30 to 33. Put 12% here. Basically, the weights are just dropping down, right? 25 here and 30 here. So basically, you've got a 45% probability if you have 1 rate cut. By my subjective assessment, you may have different assessments, but 45% probability you won't outperform cash. There's only a 55% probability you'll outperform cash, and only 30% that you'll actually beat the equity risk premium, and that's if the 10-year stays unchanged. Never mind if it starts going up higher. If you're in the camp that we're going to get no rate cuts, I say there's a 40% probability that we'll finish the year below 6,000. 15% from 6,000 to a cash return, 30% up to you'll be more than a cash return, but up to the equity risk premium, and only 15% that you'll actually outperform the equity risk premium. So now we're talking about a 55% chance that you will underperform cash. So you can have cash, or you can have this other investment where there's a 55% chance you'll do worse than cash. If you expect no rate cuts, I think that's the fair trade-off. Well, let's make it even worse. Let's say that you're going to get a curve steepener up to a 5% 10-year. At that point, I put it even money that you'll be higher or lower for the year. 50% chance that you'll be lower. Again, go back and look at the charts for October 2023. Yields going up, equity market going down. As soon as yields started giving up, equity markets started rallying. It was 1 for 1. Well, when I say 1 for 1, they were lockstep. How's that? 50%, 20% that if you are above 6,000, you'll be somewhere between 6,000 and a cash rate. 20% between the cash rate and the equity risk premium, and only 10% with a 10-year at 5% that you could beat an equity risk premium. So now there's a 70% probability you're not even going to beat cash. So no rate cuts and a steepener, cash will give you 443 at no rate cuts. To get the cash return to be indifferent, you got to get to 61.75. While the 10-year is rising, you have to have a rising equity market. I don't see that. You get the 10-year above 5%, tariffs across the board, deportations in the 100,000 per month. You're seeing wage inflation going up. Then I put it at 60% that you'll finish the market lower, 30% that you will fail to underperform cash. So now you got a 90% probability, if under those conditions, that you will not beat cash. And if others are of that thinking, which isn't unrealistic, if you're going to have that 10-year break above 5%, it's not unrealistic to say, wow, obviously you're not going to pull out any kind of significant gain on the equity market. That's going to be negative. More than likely you're going to drop. 90% chance you'll underperform cash. You got a 10% chance you'll beat cash, but a 0% chance that you'll beat the equity risk premium. So it all comes down to what happens over here. If you're in the camp of no, there'll be no rate cuts, and all of this stuff Trump is doing will be inflationary, and the 10-year is going to 5%, then how can you be bullish beta? You would have to be short beta. Let's switch cash to a 10-year bond. Okay, let's have a look at our 10-year as of Friday. 4.61 on the par curve, meaning that if there was a 10-year bond issued that day, issued at par, it would have a 4.61% coupon. That would have a duration of 7.94. So I've got 2 and 3 rate cuts priced into the 10-year. I'm going to make a statement, 2 statements right now that I doubt anybody with any experience in financial markets would disagree with. If I said that the 10-year is going to go from 4.6 to 4.5, 4.4, 4.3, 4.2, 4.1, would that be supportive of equity markets? I think most would say, well, yeah, that would be a tailwind. That would be great for equity markets to get a bull flattener on that curve. If I said it's going to go from 4.6 to 4.7, 4.8, 4.9, 5, 5.1, would that be bearish? I think most would say, well, it's certainly a headwind. It's going to be difficult for equities to climb if yields are climbing that much. I don't think anybody would disagree with those statements. So if we have a 10-year coming down, it's going to be supportive for the equity market. Let's see what the hurdle rate would be for the equity market as the 10-year came down. Because we can't just say, oh, yields are coming down, go long equities. Well, what if duration is the better trade? Let's find out. So 7.94 on the duration. If you get 2 cuts that feed into the 10-year, in other words, it drops to 4.11, the 10-year will deliver a 4% capital gain on top of the 4.61% bond yield. Equities come with a 1.4% dividend yield, so the coupon minus the dividend, you'd still have to get 3.21 off the 10-year. Why am I not using 4.11? Is because the coupon still stays at 4.61, right? And then the change in the percentage change in price, which is 4%, the equity market, just to be indifferent to the 10-year, would have to deliver 7.18%. Or 64.30. If you got 3 rate cuts, the equity market would have to deliver, the price would have to deliver 9.17 on top of the 1.4. It would have to deliver 1.97, which means you'd have to end the year at 65.50. If you think that 50 basis points can come out of the 10-year by the end of the year, the equity market would have to end at 65.50 just to be indifferent. In other words, an investment in the 10-year or the S&P would have returned the same amount at 65.50 on the market. So the hurdle rate is 65.50, but again, you don't get compensated for the equity risk that you're taking on. So I've got a risk premium here of 450, and our indifference was 7.18. So 450 on the 718 brings you to 1168. S&P would have to end at 6700. If you have 3 cuts, you'd have to get above 6820. This would be you being indifferent to the S&P versus the 10-year, and you being compensated for the equity risk premium. Now, some of you out there may be saying, whoa, you've made a mistake here. On the previous screen, we had cash with an equity risk premium of 450. Here we have a 10-year. Typically, yield curves are upward sloping, so if you do a look-back period to determine what an equity risk premium is, your equity risk premium would be a higher amount over a 3-month than it would be over a 10-year. I've used the same number because right now we're not looking over a long period of time. We're looking over a short period of time where we have a curve that has a slight slope between the 3-month and the 10-year. And if you go back to the first screen, that slope was, and I'll tell you, was 27 basis points. So if you want to rewrite this, if you want to recalculate it, you can say, well, let's take 27 basis points off the equity risk premium. I didn't bother. I just left it there at 450. So here are your hurdle rates. We're at 6,000. You have 64.30, which is 2 cuts and your cash indifference price. You have 65.50, which is 3 cuts, your bond indifference price. And if you want the equity risk premium. Because we have the long end of the curve going down, it is less likely that we'd finish below 6,000. So with 2 cuts, I dropped this to, with the long end of the curve, I dropped that to 20%. On the previous screen, I had it at 30% because I had an unchanged 10-year at 4.61. If the 10-year is coming down over the course of the year, less likely that we'll finish. With 3 cuts, even less likely. 15% is typically the historical average. That 15% of the years are down years, just as historical. Let's just put the historical in there. I get 30% on 2 cuts, 30% that you will finish somewhere between 6,000 and the 10-year indifference, 40% above that to the 6,700. There's your equity risk premium, and 10% higher. So 30% that you, with the 20, there's a 50% probability that you will finish at or below what the 10-year would do with 2 rate cuts. 40% that you do a little bit higher. That's a collective 90% probability that you will get the 10-year plus be compensated fairly for the equity risk that you're taking on, and only a 10% that you would do better than the 10-year and the equity risk premium. And again, keep in mind, we're coming off 2 big years. On the next screen, I'll show you what that means in a historical context. Let's go with 3 cuts. Only 15% of a down year, which is, you'd think, well, that's sort of normal every year. It's going to be a good year. I got 30% that we could, because you have 3 cuts now, the 10-year indifference is now at 65.50, not 64.30. So I have 30% as well, because it's the same 30%, but it's a higher hurdle. You're going from 64.30 to 65.50, 50% of getting to the ERP, and only 5% of beating that. In other words, I put a 5% probability that the S&P will finish above 68.20 this year. That is, what are we talking, 14, 15% return off of, that's a price return, which is almost 15, 16, 17% all-in return considering the dividend yield. Actually, why don't I just calculate it right now? 820 of 6,000, 13.66% return. So you'd be looking at a 15% return for the S&P. I give that a 5% chance. That's 5% that you'll get there. However, this assumes a good economy. If you have a good economy, I think these are the outcomes. There's a 15% chance that you're going to get a bad economy. So this is really 85% of 5%, 4.25% chance that you can do that. If you expect the long end of the curve to come down this year, it's not a matter of that's going to be supportive for equities. It's like, yeah, but that's also going to be good for bonds, which means your hurdle rate to beat bonds on the S&P goes even higher. Okay, let's just experiment here. I got this screen and one more screen. The next screen has a lot of really cool information on it. So what I'm going to do on this screen is just experiment with some thoughts here. Let's say the 10-year does go to 5%. A par bond with a 5% coupon would have a lower duration, 7.795. The higher the coupon, the lower duration. The lower the coupon, the higher the duration, because duration is the derivative of the time weighted, the weighting of time to its cash flows. So the lower the cash flows, the less weighting it has in the calculation. You'd have a higher duration. And let's say that the 10-year at 4.61 slowly goes up to 5% and then rallies into the end of the year, and the 10-year ends at 4%. I will assume an S&P at 5,600 if the 10-year gets to 5%. So I won't make it unfair saying, well, let's just assume we're starting at the same 6,000 on the market to figure out what the hurdle rate for the end of year would be for the S&P. If the 10-year is going to go to 5%, let's lower the market to 56%, so the end of year hurdle rate is lower. So this is a 100 basis point change in yield. once we're at 5%, you'll get the coupon plus the duration component. A bond, if you bought the 10-year at 5% and it ends the year at 4%, is returning almost 12.8%. If we start at 5,600, our indifference for year end would be 63.13. With your equity risk premium, you're 65.68. So let's look at the forecast here. This is 2025 year-end forecasts for a whole bunch of forecasters. And I've got some points drawn out. Here's the 10-year down here, plus the equity risk premium going from 5% to 4%, which is 65.68. You have a bunch of firms that are suggesting that the year end would actually be lower than that. 2 cuts, going back to the previous screen, 2 cuts plus the equity risk premium and 3 cuts plus the equity risk premium. You'd be somewhere in here, and you have a number of firms suggesting that the S&P will be at that level or lower. So only a few are suggesting, based on what I did on the previous screen with the smaller percentages, you might have thought, well, that's not really realistic. If you look at the number of firms that are projecting above 6,800, it's getting thin up there. Deutsche Bank, Yardeni, who is a perma bull, Wells Fargo, and Oppenheimer are the only ones suggesting that you could beat that the equity market would beat the 10-year given 3 rate cuts and the equity risk premium. Now that's just a 10-year. That's just a 10-year. That's just duration of 7.79. You can get better duration. The 30-year par rate is 4.84. It has a duration of 15.74. Now let's say you get 2 cuts in the 30-year so that it ends at 4.34 at the end of the year. There's your target. To be indifferent to bond, the 30-year would be 67.61. Equity risk premium, you'd be at 70.32. There is only one forecaster suggesting the S&P can get to that level. All the others are suggesting that it would underperform a 30-year bond if the 30-year put 2 rate cuts into its yield. In other words, ended at 4.34. And again, the statement I'll make is that you should have a supportive equity market if the long end of the yield curve comes down. Almost everyone would say, well, yeah, that would be a tailwind. That would be great. So to get to the 7,100, to pull out an almost 20% return, because if you're at 6,000 getting to 7,100, it's almost a 20% return. To pull out an almost 20% return, you're going to need the tailwind of lowering yields on the long end of the curve. Be difficult to outperform the 30-year if you get 50 basis points of cuts in the 30-year and get compensated for the equity risk that you're taking on. You would have to hit Oppenheimer's target of 7,100. Even Yardeni's not there. Permabull. Where's the other Permabull over here? Fundstrat, 6,600 is only saying a 10% increase. That doesn't even outperform the 10-year. Okay, a lot of really good information I threw on this screen. What are we looking at? The green bars are the equity market's positive years. The red bars are the equity market's negative years, going back, I think, about 100 years here. So you have these 2 years over here. This is 95, 96, 97, 98, 99. So this is just the 90s. So let's, this line over here is the last year that we had in the S&P, and we've heard before, to be over 20%, 2 years in a row over 20% is quite rare. So I've highlighted in this last little chart here where they have happened. You've had 2 here followed by a negative 40%. You had 2 here followed by a about 4% return. You had 2 here followed by a return that was just a little under 20%. That was 1999. And you have a lot of comparisons now saying, well, now looks like this period of time. 95 was a soft landing. We seem to have a soft landing now. We've had 5 good years in a row. 95 over 20%. 95 was 34.11%. 96 was 20.26%. 97, 31.03%. 3 good years in a row. Never mind, 98 was 26. 4 good years in a row. And 99, almost 20%, 19.53. Those are some big returns, right? 2024 and 2023 and 2024 were, I think, 26% and 25%. Not bad so far, right? Let's look at difference in context and difference in valuation. What was going on at this point in time? Debt to GDP was less than 60%. Debt to GDP is now more than 100%. Democratic government, Republican government. We're going into a Republican government now. And I'm sure you've heard this before. Markets tend to do better under Democratic governments than under Republicans. Housing here was far more affordable. Housing here is unaffordable. Not only that, let's look at valuations in 1995. And this is a trailing 12-month PE, because forward earnings are just a guess. Trailing earnings are in the books. Let's look at what trailing earnings were. In 95, the beginning of 95, January of 95, the market was trading at 14.5 times its trailing earnings. By 96, it was trading at 18.6. Beginning of 97, 19.5. Beginning of 98, 24.8. Beginning of 99, 33.3. Let's look at 2024. Beginning of 2024, market was trading at 25 times forward earnings. Higher than 95, higher than 96, higher than 97, higher than 98. Already higher than those years. So these 4 great years, the market had a very low valuation to start with. Here we're starting at 25.27. At the beginning of 2025, market is trading at 28.45. What about 2023? Because that is this year over here. Started the year at 23.27. Already better than 95, 96, and 97. So we have a very different context today in terms of the level of debt, because we can go back to 90s and say, but the 10-year was much higher then. Yeah, but debt was much lower and housing was affordable. So even though the mortgage rates were higher, housing prices were far, far lower, far more accessible. Not today. Mortgage rates at 7%, but housing prices significantly higher than where they were in the late 90s, far outpacing the wage inflation that would have happened over that period of time. And debt to GDP at this level, even though the 10-year was higher in the 90s, the debt was a lot lower in the 90s than it is today. Not only just in sheer size, but as a percentage of GDP. GDP was much lower in the late 90s than it is today. So when we say 60% to 100%, you say it doesn't sound like much, but keep in mind, GDP is way bigger today than it was in the 90s. So the debt is like an order of magnitude bigger now. What else was going on in the 90s? There was the internet build-out, 97, 98, 99, 2000. Internet build-out for everyone. Today we have data center build-out, but for companies. It's not as if every household, it's not as if we're laying fiber and copper to get to every household to connect them to a data center. The data centers are concentrated in locations and with specific companies. It's not for everyone. It's not as massive a build-out as it was in the 90s. So considering the context is different, considering that we're already starting at very high valuations, considering that more than 2-year runs are very, very rare, I see a very difficult time for the S&P to beat a hurdle rate of bonds. S&P has had two really great years. Bonds have had two really bad years. The returns on the S&P are mean reverting. They're mean reverting to a positive level, but they are mean reverting somewhere around here. I think around, without dividends, just the price return at around 7%, not counting dividends. It is mean reverting, and the return on bonds are mean reverting. And you've had 2 years in a row. I'd be more willing to bet on mean reversion. So I think that 2025, I think, is more likely to be the year of the bond than the year of the equity, considering the hurdle rate that S&P would have to hit just to be indifferent to, first of all, cash, second, the 10-year, and I doubt you're going to beat the 30-year. And that's it. Tomorrow is Inauguration Day. I don't expect much excitement around the world tonight. Other than positioning. I think the world will just be sitting around doing what I'm doing, which is, let's just wait and see what happens. I'm not going to take positions ahead of it. I'm going to take opportunistic positions as they happen, which when he says things, I'm going to, if I see something move, I'm going to say, okay, well, it's not actually going to happen the way he says, so I'm going to grab this now. So I've got a sort of fire and aim approach. Let him fire and I will take aim. And that's it.